Lori Heinel, let's look ahead to 2016, shall we? And stocks were fairly flat in 2015, at least so far. S&P is only up around 1.5%. So what's your outlook for U.S. stocks next year?
So we think it's going to be more of the same. We see U.S. economy improving by a little bit, more like 2.5 to 2.7% growth next year. But we think stocks actually will continue to be challenged, and we're looking for something in the order of sort of mid-single-digit returns.
And what about over in Europe? A lot of people say that the weaker euro, and it's going to get weaker, is going to help their exports, really lift the economy. That said, any worries about what's going on in the wake of the Paris attacks?
Well, look, the Paris attacks were certainly, from a human perspective, really awful, and there are always opportunities for that sort of thing to happen. Our core forecast, though, is that the ECB will remain quite accommodative. In fact, we're likely to see Draghi enhance their quantitative easing program later this week. And so we actually think that will provide the backdrop for Eurozone to actually do better than the U.S. And we think for some investors who are a little bit more nervous about the currency, we might do that on a hedged basis.
And this was a big year for watching China and the emerging markets. Even the Federal Reserve was watching China to see their growth. So what's your outlook for emerging markets, and specifically China?
Yeah, so we actually think China will continue to grow at about 6% next year. So that's right in line with consensus. We think that the risks are skewed to the downside, but they do still have ample ammunition to support their markets and support their economy. And we also saw that just recently the IMF actually made them a reserve currency. So we think that that actually bodes quite well. Overall, emerging markets does benefit from cheaper oil prices, although there are, of course, winners and losers. But we're still cautious. We think that return on equity in the emerging world is still actually lagging behind the developed world, and we don't think that the valuations are attractive enough to enter just yet.
Another big worry in 2015 was high yield, where we saw yields move up and the prices come down. A lot of worries about defaults, so especially in the energy patch. So what's your view of high yield heading into 2016?
Yeah, so there again, it's a tale of two cities, right? So as you rightly note, energy will continue to be challenged, and that's been one of the areas within the high yield market that has had a few landmines. But we think overall, corporate health is quite good, and if we're right about the backdrop on the economy, we think that the rest of the high yield markets will continue to do quite well. But it will definitely be a bond picker's market there.
All right, so why don't you put it all together for me? If you're going to put together a portfolio for 2016, what it would look like?
Yeah, so we think for the most part, stay true to your strategic allocation, but try to find ways to be a bit more active in the portfolio, a bit more tactical. We're currently holding a fair amount of cash because we're looking for better entry points into things like emerging markets equities. We would be generally overweighting Eurozone and Japan from a developed market perspective, and we'll be generally overweighting credit and high yield from a credit, but there again, being very active and focusing on security selection versus just the beta trade.
All right, well, thanks a lot, Lori. And thank you for watching The Street.